Did you know there's an Indian company turning over 250,000 metric tons of scrap into valuable raw materials every year? And it's not just doing it in India, but across multiple continents. That company is Gravita India, a rising name in the global recycling industry. In this video, we break down Gravita India's business model, financial growth, expansion plans, and the sustainability drivers shaping its future. Stick around as we explore how this company is making recycling a high-margin, high-growth business. Gravita India is one of the country's leading recycling companies with operations across lead, aluminium, plastics and turnkey recycling solutions. Lead is its core segment, contributing 88% of revenue, followed by aluminium and plastics. Gravita doesn't just recycle, it transforms scrap into value-added products like lead alloys, aluminium alloys, PET flakes and tire oil. Currently, these premium products account for 45% of revenue, with plans to push that above 50% by FY27. FY25 was a standout year for Gravita. Revenue reached 3,869 crores, up 22%. EBITDA came in at 404 crore rupees, also up 22%, with margins holding steady at 10.43%. PAT was 312 crore rupees, a 31% jump, giving it a solid PAT margin of 8%. Over a 5-year period, revenue has grown at a CAGR of 23%, PAT at 49% CAGR, reflecting strong margin expansion, and Gravita's stock price has delivered a stellar 5-year CAGR of 118%, signaling robust investor interest. EBITDA per ton shows strong unit economics: 19,000 rupees for lead, 10,300 rupees for aluminium, and 20,800 rupees for plastics. Gravita's ROIC for FY25 stood at 27%, in line with its long-term benchmark for maintaining ROIC about 25%. It is now net debt-free, and FY25 saw operating cash flow grow nearly 6x to 282 crores. 1,000 crore rupees QIP raised during this year is funding aggressive expansion and debt repayment. Gravita plans to increase total capacity to over 500,000 MTPA by FY27 and cross 700,000 MTPA by FY28, backed by a 1,500 crore capex plan. It's entering new verticals like lithium-ion battery and tire recycling, aligning with India's EV shift and global green goals. Recent acquisitions include a tire recycling plant in Romania and a battery recycling facility in Mundra, strengthening its global footprint. Gravita serves 325 plus global customers across 32 countries and 200 plus clients in India. It operates through 31 yards, 1,700 plus sourcing points, with a manufacturing presence in India and abroad, including Ghana, Senegal, Sri Lanka, Oman, and Romania. In FY24, international markets contributed 32% of revenue and over 53% of profits, thanks to better margins abroad. Regulations like BWMR and EPR are tailwinds for Gravita. They create mandatory recycling obligations that increase demand for companies like Gravita. As of FY25, 43% of scrap was sourced locally, up from 30%, boosting supply chain efficiencies and margins. The company also aims to source 30% of its energy from renewables and reduce energy use by over 10%. Gravita targets volume CAGR of 25% plus, profitability growth of 35% plus, sustained ROIC above 25%. It plans to increase non-lead revenue to 30% plus and value-added contributions to over 50% by FY28. With a strong order book and large capex pipeline, the company appears well-positioned and subject to execution and regulatory approvals. Also worth noting, Motilal Oswal recently bought 7 lakh shares, signaling institutional interest. This video is for informational purposes only and not a stock recommendation. If you found this analysis useful, like, share and subscribe to Tradejini for more such deep dives. Click in the description to read the full research report on Gravita India.
Download Cube Plus now.
Investments in the securities market are subject to market risk. Read all the related documents carefully before investing. The securities are quoted as an example and not as a recommendation.